In this short video, I want to look at a key issue for lifetime savers, which is how, in practical terms, do you manage market cycles? How do you manage the fact that in the short term, the stock market can be quite volatile, but over the long term, history suggests that it is actually one of the best places to put long-term capital to work. Okay, so the challenge is this. As somebody trying to build wealth over a lifetime, you've got two opposing forces. There's the safety angle. I don't want to lose money. All right, I need to hit my targets in terms of investing and saving, and I need to be able to afford to do the things I want to do. And that can drive people into cash. And cash has its place in an overall investing strategy, but it suffers from a sort of almost fatal drawback, which we'll look at in just a moment. On the other hand, you want to earn decent returns. So if you sit in cash for too long, as we'll see in a moment, your money's eroded by inflation and so on. So you want to earn decent returns, and that tends to take people into shares. I mean, it can take people into property. Owning your main home makes perfect sense. There's a big capital gains tax exemption there. But frankly, for a lot of people going any further than that, straying into buy-to-let, is pretty stressful, pretty time-consuming, and not something they want to spend time doing. So beyond your main home, most people tend to look to shares, or should look to shares, to offer them those long-term inflation-beating returns. Now, the problem with cash is this. So how do we balance the two sides of that equation, if you like, or that dilemma, safety versus decent returns? Here's the problem with cash. Cash has its place, but this chart shows what has happened to the purchasing power of £100 from the 70s all the way through to more or less today. That actually finishes pretty much today, early 2015. The purchasing power of £100, and I'm afraid is a pretty depressing picture. Here it goes. Purchasing power, by the way, means what it will actually buy. So £100 plummets in real terms to nearer sort of 10p or slightly below even over that timescale. So although cash appears to be safe, and in the short term it certainly has its uses, over the long term it's actually not safe at all because your wealth is being destroyed. Someone looking to is up for retirement is going to have a terrible time if they sit for too long in cash. What's more, we don't know what's going to happen to inflation. People look and say, well, actually, the cost of goods and services seems to be, if anything, falling. We're almost heading for a deflationary environment. But let's just take a sort of common sense check on where we've been in the past. Yes, at the moment, inflation is relevant when you're calculating your real return. Real returns matter. It's not a case of just saying, what do I earn on a cash account, for example, 2%. What is happening to the cost of goods and services influences what you can actually buy, your real purchasing power. Now, at the moment, we may be close to zero, and we've been bobbling around at the same level for a little while now. But, history, if nothing else, and the past is never a complete predictor of the future, but history suggests we're not going to stay there forever. I mean, look at some of these enormous spikes. I mean, hard to think, for sort of younger savers and investors that we've been, well over 20% in the past on inflation. And what's more, it can spike quite quickly. I mean, look at just this one, for example. All right, back here, we were close to zero, and then suddenly up here, we're at nearly 25%, and that gap is only around 20 years. So not only can inflation change, it can also change quite quickly. So although there's all this doom and gloom around about, deflation, watch out, because inflation has a habit sometimes of kicking up quite sharply. All right, and that is even worse news potentially for anyone who sits in cash for too long. Now, why do I say that? Well, looking back over some decent time periods, now the past is never a guarantee about the future, of course it isn't, but it does at least give us some picture as to where we should be headed with our long-term investments. If we look at 2014, that was a fairly exceptional year. You might be looking at that, and I've put it up there, thinking, crikey, what was going on there? I mean, the anomaly is this number here. Government IOUs in 1 year, a higher return than either cash, which was actually negative, so losing money in real terms, this is real after inflation returns, or equities. And that, of course, is a consequence of several unusual forces at work. We've had all this quantitative easing, so basically central bank money being driven into the bond market, all right, pushing up government IOUs. We've had the flight to safety angle, as people have looked around at, could any of these crises around the world turn into something much worse. You've had the sort of flight to safety into those assets as well. And of course, when people are looking at slightly uncertain times, will volatility increase? Wealthy international institutional investors have to park their money somewhere, even if the returns are pitifully low. And we've seen on some government IOUs around the world, the return actually turned negative, which suggests that some investors are prepared to actually pay to give someone else their money. So we're in a kind of bizarre world. So personally, I would take 2014 with a pinch of salt. How reliable a guide is that to the future? Why don't we look back at the last 50 years, and then just for good measure, the last 115 years. But I think that one is more relevant. And whilst the past is no guide to the future, you can see there that equities on a real post-inflation basis per year have done considerably better than either UK government IOUs, this is the UK market I stress, or cash. All right, and that's something you need to bear in mind. But the problem with equities is they can be volatile in the short term, so you've got to get the kind of right mindset, and that's really what this video is all about, is managing that volatility. Now, what do I mean by volatility? Well, I mean this. If we were to look at, say, the FTSE All-Share, that's a pretty representative index of activity in the UK market, and we were to look at what would have happened to £25,000 invested at the start of one of the worst bear markets we've seen in recent history. The 70s bear market was an absolute killer disaster in terms of what it did to share prices. So let's go in at the beginning, let's get our timing almost as badly wrong as you could possibly hope for. Nonetheless, someone who hung on in there could have seen subsequently pretty decent long-term returns from equities, but fair to say with some pretty hefty blips, to put it mildly, along the way. And there are two big ones. And actually back here, this was a monster. It's just the way the graph's constructed. It doesn't look like it's. I'm going to blow that up in just a moment. So we could look back and say there have been at least three really quite severe drops. This one, as you'll see in a moment, was around 2/3. This one around 50%. And this one around 50%. But here's the thing. The eagle-eyed people looking at this graph might notice another thing, which is quite difficult to see here. The market actually recovers peak to peak quite quickly. And that's really quite key to what I want to say next. Because what you don't want to do is to put yourself in a position, you never want to panic sell. So anyone who panic sold here will have regretted it, or panic sold there, bailed out when everyone else was bailing out, or certainly as the bear market, the early 70s got underway, never be a panic seller, but also you don't want to be a forced seller. You've got to manage your cash flows in such a way that you're not kind of kicked out of the market at just the wrong time, trying to release capital to pay for something that you need. So knowing that these peak-to-peak cycles are a certain length in the UK market is helpful. Now, just to emphasise the point, didn't make it very clear on the previous graph because of the way it's been put together, but there is that disastrous early 70s bear market. So I'm suggested, we've started investing there, and crikey, just 3 years later, you'd have been down to about 1/3 of your original investment. £25,000 would have become about 8,600. And you've been thinking, crikey. Now, provided you didn't have to liquidate here, all right, and or you certainly didn't panic and bail out of the market, things were okay. I mean, 3 years later, you were back to kind of break even, peak to peak, let's say. Now, what do we conclude from that? Stocks do tend to rise consistently over time. Right? That is a pattern you can say, looking back at the UK market on an all-share basis. If you include dividends, it's certainly true. If you don't include dividends, it's true. But big bouts of volatility are definitely possible. Just because we haven't seen one for the last few months or so doesn't mean that there isn't another one potentially coming down the line. Peak to trough falls of 50% or more, up to 2/3 in the early 70s are possible. But the market tends to recover, and it does it relatively quickly in the context of lifetime saving, which is a period of 40, 50 years. All right? The market recovers, and what's more, therefore, market timers need to be a little bit careful. So, what can we conclude? In the UK market, now this is the UK market, there are exceptions like Japan, for example, but I'll talk about that in a separate video. In the UK market, the all-share cycle appears to last between 5 and 7 years. And what does that mean for someone trying to make that allocation decision between, say, cash, safety, and trying to generate decent returns themselves in shares? Well, Here's what it means. The overall goal, maximise the time you spend in the equity market, and I haven't really factored in income here, but anyway, maximise the time you spend in the equity market whilst making sure you're not a forced seller. How do you do that? Possible approach, right? Possible approach to solving this problem. You need a rainy day fund to cover unforeseen calls on capital. You need to set aside, now the amount varies from person to person, depends on circumstances, but let's say 3 to 6 months of salary for that leaky roof, all right, for the car breaking down all of a sudden, for an emergency, you might be made redundant, you might be ill, anything. So we do need that, and that is going to need to be in cash or something pretty close to cash. Identify foreseeable calls on capital and when they crystallise. All right, now, this is not something I cover in detail in this video, but plan for when you might need, depending on what age you are, that house deposit, or if you're a bit older, when you might need to pay for a wedding, or when you might want that massive one-off holiday. The call on capital could be a number of things, but the more planning we do, the better this system becomes. For time frames of up to 7 years, save mainly in cash but be flexible. So the idea is, if you look at that market cycles point I made just now, you want to be looking at time frames up to 7 years mainly in cash, because we know that someone going into the market at the moment might fall foul of one of those larger dips that I identified on the previous graph. Beyond 7 years, funds should be lifetime saving. So what we're saying is, yeah, you need to be keeping your eye on cash for a time frame of less than 7 years, but beyond 7 years, you want to be mainly in equities, because otherwise you're not going to be able to generate decent enough returns in the context of paying for big things like retirement. But let's be active, let's monitor our portfolios, all right? Let's make a judgment call. So the point being that a foreseeable call on capital might start well outside the 7-year range, so you commit to equities, but of course as time goes by, it will get closer and closer and closer, and it will move into that 7-year range. And you need to make a judgment call about where you think the equity market is in its current cycle. You need a discussion about that, potentially do some research, and make a judgment call about the allocation decision you make between equities and cash as a result. Therefore, big conclusion, lifetime saving, a lot of it, the success of it, is down to planning. Now, covered a lot of ground there. Any questions on that, please contact me, editor@killick.com.